sorry, the rival to the dollar rather is already here, and it's the one you pointed to. It's gold. Right now, by the way, very few people realize this. The United States has 70% of its reserves in gold.
Also, he's from Strategic Intelligence. He's the editor there, Jim Rickards, and also his new book, Money GPT, AI and the Threat to the Global Economy. Jim, I just got to get your thoughts on these outcomes, market reactions, especially, obviously, with our own election in November.
Yeah, it's a big topic, Charles. My former boss, Walter Wriston, probably the second greatest banker of the 20th century after Pierpont Morgan, said capital goes where it's well treated. Pretty simple statement. You can get as sophisticated as you want in the analysis, but that's basically true. So investors look at tax policy, capital controls, exchange rate stability, growth potential, any other headwinds to growth or pro-growth policies, and that's where the capital goes. Right now, it's leaving China. It's going into India, although there was that correction that you pointed to just in the last 24 hours as the Modi vote came in. But on the whole, India is still an attractive destination for capital. Mexico looks unfriendly. So it's kind of that simple. As long as you don't put capital controls on, capital will go where it's welcome.
All right. But I think there's a message there perhaps for our viewers come November. Hey, I saw a chart. I want to get your thoughts on it. And actually, so we've got the S&P 500, which is the yellow line. It's obviously surged. And for years, for decades, it's sort of just always sort of gone along with the tonnage in trucks. But truck tonnage has gone sideways here for a while. Now, one commentator said this was a result of financialization, which I want to kind of let the audience understand what I'm talking about here. The financialization, the most cited definition from Gerald Epstein states, it means the increasing role of financial motives, financial markets, financial actors, and financial institutions in the operation of the domestic and international economies. And this is how, I mean, is this a sign of that, that perhaps, the financial engineering, it matters more for the economy, at least for markets, than actual economic growth?
Yeah, definitely, Charles. It's very powerful. So now whenever you see two indices or two metrics that correlate and then they diverge, you have to ask yourself, well, which one of them is off? Which one of them is sort of still giving you reliable information? Which one of them is maybe subject to a bubble? I can explain the trucking going flat. That's a combination of COVID and the supply chain breakdown. If you look at that, the timeline on that, and possibly the U.S. going into a recession. So that makes sense. When I see the stock market going, almost vertical, it tells me that the stock market's in a bubble. So those two lines will they'll converge, they'll come back together, but it's going to be the stock market going down rather than, trucking suddenly soaring.
Jim, also want to talk about the reports of the death of the U.S. dollar. Obviously, some saying it's greatly exaggerated. Here's the SWIFT payment system of late. The U.S. dollar actually taking a much bigger share here recently. But I also saw another chart, and I thought about you. We said, we got to call Jim. So this is assets, right, around the world in terms of reserve assets. So the U.S. dollar is this part here, and it's holding in there pretty good. But we're starting to see gold really take off right here. And I'm wondering, could the dollar be supplanted not by another fiat currency, but by something else other than the fiat currency?
Well, you're right, Charles. Fiat currencies do supplant each other over time, but it's a very slow process. Classic case, sterling was at its peak in about 1914. By 1944, Bretton Woods, it was sort of a footnote. But that took 30 years. It didn't happen overnight. So is the dollar running into a lot of headwinds? Actually, I always say that the world cannot destroy the dollar, but the U.S. can do it itself, and we're doing a pretty good job of that. But you're right. Dollar, round numbers, is about 60% of global payments. It's the currency of about 60% of global reserves, so it's still the king of the hill. You can forget about there's not going to be a gold-backed Chinese yuan. Forget about that. China doesn't have enough gold. Russian ruble is not going to displace it. Russia and China don't have the rule of law or the bond markets. Those are key things about being a reserve currency. The BRICS currency is coming along, but it's going to take another 5 to 10 years. The key thing there, it's easy to announce a currency, a payment currency. That's just a ledger entry. What you need is a large enough trading area where if I get some, I export and I get paid in BRICS, I can go shopping in 20 countries instead of 1 or 2 if I'm getting rubles or yuan. They're not there yet, but they're adding members every year. They'll add some more at the summit in Russia in October. That'll take a few more years. However, the rival to gold is already here, and it's the one you pointed to. Now, we don't need foreign currencies because we print the dollar, but that's the data. Russia has 25% of its reserves in gold. China has about 8% of its reserves in gold. And those numbers are both going up. Interestingly, when you look at the IMF data on currency shares, they have dollar, euro, Canadian dollar, Australian dollar, and so forth. They give you all the data. You can compute the percentages quickly. They don't include gold, which is weird because the IMF itself has over 1,000 metric tons of gold. So when you put gold in the picture, two things are happening. Number one, the inversion was 2010. That's when central bank gold reserves started going up. That's accelerating. And now the U.S. is just a week away. June 13th, G7 summit in Italy. The U.S. is going to lead an effort to steal $300 billion of Russian-owned assets in the form of U.S. Treasury securities. When that happens, you're going to see, again, the Treasury market's not going to collapse. I don't want to overstate this, but at the margin, if you can't trust the Treasury, do you really want Italian, German, or Japanese bonds? I don't think so. You're going to want gold.
Right.
Yeah, thank you. So I look at the economic debate that's going on, the economic policy debate with Trump campaign and the Harris-Walz campaign. Peter, I put this in the context of a 235-year-old debate. It goes right back to the George Washington administration. And there are two, broadly speaking, there are two sides. There's what's called, became known as the American system. And this was Alexander Hamilton, Henry Clay, John Quincy Adams. You can go right through. Abraham Lincoln was one of the biggest advocates and proponents. William McKinley, Dwight Eisenhower because of infrastructure, Ronald Reagan, and Donald Trump. On the other side, you have this, what started out as agrarian, but later became globalist neoliberal, and that's Jefferson and Madison, the Jacksonian presidents, Andrew Jackson, Martin Van Buren, James Knox Polk, and then in the 20th century, Woodrow Wilson, Truman, Kennedy, because of the 1962 Trade Reform Act. I would say Bush 41, Clinton, Bush 43, Obama, and Biden, and I would single Clinton out for admitting China to the WTO in 2001, a World Trade Organization. So those are our two sides. There's the American system, and then there's the globalist neoliberal consensus. The American system has four pillars, classically. One is tariffs. If you want to sell in the United States, that's fine, but build it here, put money here, and then create U.S. jobs, American jobs. Two, infrastructure investment, and it doesn't mean the government can't play a role. The government has played a role in railroads and the Boulder Dam, Grand Coulee Dam, and so forth. But infrastructure investment, productive investment, not wasteful investment. Three, a strong defense, not to run around the world and start wars, but to basically protect the United States and pursue its interests. And then the fourth one would be a national bank, but we're not talking about today's Federal Reserve. We're talking about something more like the second bank of the United States, where it had a pretty simple task, which was it took government debt and issued its own debt, and so in the form of bank notes. Well, where I went to law school, no, it was a debt, which it is. But those notes could circulate and provide liquidity. So those are the kind of the four pillars, and then. Those that William McKinley summarized this very well, because when you talk about tariffs today, and you've obviously worked on them, Robert Lighthizer, I think you, Lighthizer, and Trump together are kind of a super brain trust on this point. But the criticism is always, hey, if you put a tariff on, you're going to raise prices. That's inflationary. And McKinley said, you might raise prices for a short period of time, but wages will go up even more, which means real wages are going up. As long as the real wage increase is higher than whatever comes out of the tariff, real wages are going up. One of the biggest things going on right now is obviously the war in Ukraine. I know we want to talk about economics, not geopolitics, but they're related at some level. So the Biden administration has hammered Russia with, 12 or 13 rounds of sanctions, all of which have failed, by the way. Wally Adeyema's, he might know the law of sanctions, but he doesn't know anything about economics and how things actually work. I mean, I used to work with Mark Rich, and, you can run rings around sanctions. But here's the point. If you really want to defeat Russia, if you want to defeat Russia as much as Biden and Harris say, All you have to do is get oil to $40 a barrel. In other words, drill, baby, drill. Now, Trump advocates that for a lot of reasons, economic reasons, et cetera. But $80 a barrel oil or $75 a barrel oil is sustaining Russia. It's feeding the war machine.
Right.
Sanctions don't work. So get oil to $40 and Russia, Putin will show up at the negotiating table. There's an example where what they say, which is we have to stop Russia, at the risk of World War III, et cetera, and what they do shows complete incompetence, because if you really did want to stop Russia, you'd get oil at $40, which you can do if you open up the U.S. tabs to build the Keystone Pipeline.
Well, that's the inexperience and lack of training in economics, because that's brilliant. I mean, that's exactly right. We had oil substantially lower for 4 years under Trump. Putin would like oil to be at $100 a barrel. Saudi Arabia needs about 80 for its social welfare giveaways. And they now control the OPEC cartel price-making decisions because we've lost our place in terms of strategic energy dominance.